Global energy markets unfazed by Trump 11 summit. What's really driving oil prices? The highly anticipated meeting between former President Trump and President Xi in South Korea, touted as a potential thawing of US-China tensions, failed to ignite any sparks in the oil markets. But here's where it gets interesting. Instead of focusing on crude oil or LNG, discussions centered around fentanyl, leaving energy traders looking elsewhere for direction. All eyes are now on this weekend's OPEC Plus meeting, though whispers suggest a predictable outcome, a modest 137,000 barrels per day production increase. This could mean ICE Brent prices hovering around $65 per barrel for a while longer. Saudi Arabia slashes prices, Asia rejoices, sort of in a move that will ripple through Asian markets. Saudi Aramco is expected to significantly cut its Asian formula prices, potentially dropping them to multi-month lows. Analysts predict a $1 to $1.50 per barrel reduction, driven by increased Middle Eastern exports and a flattening Dubai futures curve. US-China port fee truce, a temporary reprieve. A glimmer of cooperation emerges as China and the US agree to suspend reciprocal port fees, offering a temporary boost to shipping markets. However, the Trump administration's silence on confirming the one-year suspension leaves a lingering question mark. India defies sanctions, continues Russian oil imports. Despite global pressure, India's largest refiner, Indian Oil, has purchased 5 cargoes of Russian oil from non-sanctioned entities for December delivery. This equates to a substantial 120,000 barrels per day, highlighting India's continued reliance on Russian energy, even amidst geopolitical tensions. Gunvor snaps up Lukoil's global assets. In a significant shift, Russia's Lukoil has accepted an offer from trading giant Gunvor to acquire its international assets, including the massive West Qurna 2 oil field in Iraq and several European refineries. This move signals a strategic reshuffling within the global energy landscape. Mozambique challenges LNG project costs. Mozambique's government is pushing back against TotalEnergies' revised budget and timeline for its 13-par LNG project. A reported $4.5 billion cost increase during the project's 4-year hiatus due to security concerns has raised eyebrows, prompting Mozambique to seek further negotiations. China's teapots roar back to life, but for how long? Refinery margins are on the rise in China's Shandong region, pushing refinery runs to a 2025 high of 71% in October. However, this resurgence may be short-lived as Beijing's crude import quotas near depletion, forcing many refineries to curb production. Nigeria imposes fuel import tax, eyes domestic refining. Nigeria takes a bold step towards energy independence by imposing a 15% import duty on gasoline and diesel. This move aligns with its long-term goal of boosting domestic refining capacity, despite the underwhelming performance of the 650,000 barrels per day Dangote refinery, which continues to rely on 170,000 barrels per day of gasoline imports. Greenland's untapped oil potential sparks drilling interest. A recent report by Sproul estimates Greenland's gross recoverable oil resources at a staggering 13 billion barrels, with the majority located in the untapped Jameson Basin. This discovery has ignited interest in drilling activities for 2026 to 2027, potentially opening up a new frontier in the global energy market. Brazil and Colombia join forces in gas venture. Ecopetrol and Petrobras have formed a strategic alliance to develop and market natural gas from Colombia's offshore Sirius block, estimated to hold 6 trillion cubic feet of gas. Production is expected to commence by 2029 to 2030, strengthening energy ties between the two nations. Henry Hub soars on LNG export boom. Henry Hub gas futures surged past $4 per MMBTU, marking a nearly 20% jump from November 2025 levels. This spike is fueled by robust feed gas demand and the commencement of December delivery contracts, highlighting the growing influence of US LNG exports on global gas markets. Qatar secures long-term Indian gas deal. Qatar Energy has inked a 17-year agreement with India's Gujarat State Petroleum Corporation to supply 1 million tons per annum of liquefied gas. Deliveries are set to begin in 2026, with pricing reportedly linked to Brent crude at around mid-12%. This deal underscores Qatar's strategic focus on the burgeoning Indian energy market. Kuwait's refinery outage adds to Asian crude glut. An unplanned outage at Kuwait's Al Zour refinery, following an October fire, has led to the sale of 3 million barrels of excess crude to Asia. This additional supply exacerbates concerns about oversupply in the already saturated Asian markets. Copper's meteoric rise continues. Copper prices have reached an all-time high of $11,200 per metric ton, fueled by supply shortages and a positive economic outlook. Hedge funds have capitalized on this trend, pushing their long positions to an 8-month high. However, a stronger dollar towards the end of the week tempered the rally slightly. Food for thought: while geopolitical events often grab headlines, the intricate dance of supply, demand, and market dynamics ultimately dictates energy prices. What do you think? Are we headed for a period of price stability, or are there hidden factors that could disrupt the current equilibrium? Share your thoughts in the comments below.